Good day, everyone. Good day, everyone. Welcome to today's session on transfer pricing risk management. In this lecture, we will delve into the complexities of transfer pricing, focusing on the risk involved, how to effectively manage them, and how companies can navigate the challenges of compliance. Transfer pricing risk management is crucial for businesses operating across multiple jurisdictions, ensuring they maintain compliance with tax regulations while minimizing their exposure to penalties and adjustments. Yes, this is Module 9, and we will be talking about transfer pricing risk management. We will cover the following topics today: identifying transfer pricing risk, key strategies for managing those risks, real-world case studies illustrating successful transfer pricing risk management. So let us start with an introduction to what transfer pricing is and why it is so important. So let's look at definition of transfer pricing risk. Transfer pricing risk refers to the potential exposure that a company faces when intercompany transactions between related parties are not in compliance with the arm's length principle. This risk can lead to tax adjustments, penalties, double taxation, or reputational damage. Key drivers of transfer pricing risk include regulatory changes, complex transaction structures, economy, economic volatility, and poor documentation. Now, before we go further, let us look at the definition of transfer pricing risk management. What we defined earlier was transfer pricing risk. Now, transfer pricing risk management is the systematic process of identifying, assessing, mitigating, and monitoring the risk associated with intercompany pricing practices. This process ensures that a company's transfer pricing policies are compliant with both local and international tax laws, reducing the likelihood of audits, disputes, and financial penalties. So effective transfer pricing management involves the use of robust documentation, other regular reviews, and proactive engagement with tax authorities. So overview, let's look at overview now. The goal of transfer pricing risk management is to minimize exposure to compliance failures, audit adjustments, and tax penalties. So with the global regulatory environment becoming stricter and more coordinated, businesses must take proactive steps to ensure their intercompany transactions are accurately priced and documented. We'll now be looking at the common transfer pricing risk. So let us explore some common transfer pricing risks that companies need to manage. One, regulatory non-compliance. These occur when a company fails to follow local or international transfer pricing standard or regulations, which can lead to audit, adjustments, and significant penalties. Second one is the documentation deficiencies. So transfer pricing regulations require detailed documentation that supports the arm's length nature of transactions. Incomplete or inadequate documentation can increase a company's risk of penalties during a tax audit. Now, the third one is inappropriate transfer pricing method. Using incorrect or inappropriate methods for pricing intercompany transaction increases exposure to transfer pricing adjustment by tax authorities. We've looked at the various methods. We've also explained how to select the appropriate method. So it is important that we use the appropriate method to avoid penalties. Market and economic changes. Fluctuation in market conditions, such as economic downturns or changes in demand, can impact the comparability of transactions and create transfer pricing risk. Now, let's look at complex transactions. Now, transactions involving intangibles, services, or complex financial arrangements are more difficult to price accurately and thus more likely to be scrutinized by tax authorities. Here, we've also looked at this as well in our previous modules, where the tax authorities are usually more interested in complex transactions in order to scrutinize and to ensure that the appropriate transfer pricing methodologies were used. So we move to audits and adjustments. So with the increasing scrutiny from tax authorities and advanced data analytics tools, the risk of transfer pricing adjustment during audit is growing. Is really, really growing, and people need to be proactive. Companies need to be very, very proactive. So now let's look at the strategies for managing transfer pricing risk. So now that we have identified the risk, let's look at the strategies to effectively manage them. A proactive approach can save businesses from costly penalties, disputes, and reputational damage. You can imagine the demands from Internal Revenue Service US of about 3.3 billion in our previous sessions from one of the big multinational entities. So it is important to have strategies to manage transfer pricing risk. So now let's look at one, comprehensive documentation. So the foundation of every transfer pricing risk, or the foundation of effective transfer pricing risk management, is comprehensive and accurate documentation. The foundation of effective transfer pricing risk management is comprehensive and accurate documentation. There's a reason for repeating that. So this ensures transparency and allows companies to defend their pricing practices during audit. Documentation is very, very important. Maintain detailed records. So now you need to look at it from this point that it is essential that companies maintain detailed records of intercompany transactions, including detailed record of intercompany transactions, including master file, local files, and country by country reporting. Now we are still looking at it under comprehensive documentation now, where you maintain detailed records and you also do regular updates. So it is essential that companies maintain detailed records of intercompany transactions, including master file, local files, and country by country reports to ensure compliance with local and global regulation. Now, with respect to regular updates, which is still under comprehensive documentation, transfer pricing documentation should be updated regularly to reflect changes in business models, economic conditions, or regulatory frameworks. Now, to two, robust transfer pricing policies. Another critical element of managing transfer pricing risk is having robust policies in place. One, under robust transfer pricing policies, let's look at aligned with arm's length principle. The core of transfer pricing risk management is ensuring that intercompany transactions adhere to the arm's length principle. This means that transactions between related parties should be priced as if they were between unrelated independent parties. The next one under robust transfer pricing policies is consistent application. So it is important that transfer pricing policies are applied consistently across all jurisdictions where the company operates. Inconsistency could attract attention from tax authorities and increase the likelihood of audit. Moving to the third one, proactive monitoring and review. So regular monitoring and internal reviews help companies stay ahead of potential risk. Now, the first under the proactive monitoring and review is internal audits. So there should be, the company should conduct periodic internal audits which allow businesses to identify and correct potential compliance issues before they are detected by tax authorities. I usually call these health check. So it is important you do transfer pricing health check before the tax authorities come around. So after the proactive monitoring and under proactive monitoring and review, we have the benchmarking studies. So regular benchmarking studies are necessary to compare intercompany transactions to similar uncontrolled transactions, ensuring that prices remain in line with market condition. So now we continue with the next. The next one is engage with tax authorities. A key risk management strategy is maintaining an open dialogue with tax authorities, and one of these is advanced pricing agreements. An advanced pricing agreement is a formal agreement with tax authorities on the methodology to be used for pricing intercompany transactions. Advanced pricing agreement provides certainty for future transactions and reduce the risk of dispute. We already talked about um, advanced pricing agreements in our previous modules. If you want to know more, you can, go back to the previous modules and understand what advanced pricing agreements is. So regular communication. Engaging in regular communication with tax authorities about any major changes in business operation or transfer pricing arrangement can help reduce risk as well. Now, the next one, which is number 5, is use of technology. The use of technology is becoming increasingly important in transfer pricing compliance. Let's also look at the automated systems. Automated systems can help businesses manage the complexities of intercompany transactions by streamlining processes and ensuring accurate documentation. Still under the use of technology, let's look at data analytics. Now, using advanced data analytics can help businesses identify trends and potential risk in their transfer pricing practices, ensuring any anomalies are addressed quickly. Now, training and education. This is the last one. Finally, ensuring that all relevant staffs are well trained. Excuse me. Finally, ensuring that all relevant staff are well trained in transfer pricing practices is crucial. Under the training and education, we look at staff training. Train your finance, tax, and legal teams on transfer pricing rules and documentation requirements so that they can manage the risk effectively. It is important to continue to, train your staff so that they can be updated to manage your transfer pricing risk. And stay informed. Continuous learning is also key. Companies should stay updated on changes in transfer pricing regulations and industry best practices to ensure they remain compliant. So that is that on the strategies. Now let's move to case studies on transfer pricing risk. So we're going to illustrate these strategies in action. Let us look at some real world case studies. Now let's look at a multinational corporation's comprehensive risk strategy. So for example, looking at the overview, for example, let's say XYZ Corporation, a multinational enterprise operating in over 20 countries. Let's say, faced significant transfer pricing risks due to the complex nature of its intercompany transactions, particularly those involving intellectual property and service arrangements. Now, let's look at implementation, for example. So, comprehensive documentation. XYZ Corporation maintained extensive documentation, including master files, local files, and CBCR, ensuring that all intercompany transactions were fully supported. Now, internal audit. The company conducted regular internal audit, which is transfer pricing health check, to identify and address potential risks before they are escalated or noticed by the tax authority. Now, benchmarking studies. XYZ performed regular benchmarking studies to ensure that their pricing was in line with industry standard. Then engagement with tax authorities, the company proactively entered into bilateral advanced pricing agreements with tax authorities in key jurisdictions to mitigate future risk. So the outcome definitely will have a positive outcome since they follow all the necessary strategy. Through a comprehensive approach, XYZ Corporation significantly reduced its exposure to transfer pricing risk and successfully avoided costly disputes and penalties. Now let's look at another case study. Now, this time around, we're looking at an SME, a local SMEs that uses technology for transfer pricing compliance. So, ABC Limited, a Nigerian small and medium enterprise, faced challenges in managing his transfer pricing risks due to limited resources and expertise. However, the company adopted technology solution to overcome these challenges. Now, I'm sure this is going to benefit a lot of SMEs that will be operating within the ECOWAS countries, or SMEs that will be operating within the African Continental Free Trade Agreement area. So these are things that are going to be very useful for small and medium enterprises operating within ECOWAS and after. So let's look at an overview. ABC Limited, a Nigerian SME, faced challenges in managing its transfer pricing risks due to limited resources and expertise. However, the company adopted technology solutions to overcome these challenges. Now, implementation, they had automated system. ABC Limited implemented an automated system to document and track all intercompany transactions, ensuring transparency and compliance. They also used data analytics. The company used data analytics tools to monitor its pricing practices and identify any deviation from the arm's length principle. Staff training, finance and accounting teams were trained to understand the complexities of transfer pricing and ensure compliance. Now let's look at the outcome. ABC Limited successfully reduced the complexity of its transfer pricing process, improved accuracy, and mitigated risk through the use of technology and training. That is the outcome. Let's look at another case study which talk about engagement with tax authorities. So DEF Pharmaceutical Company, a global pharmaceutical company, was concerned about the increasing scrutiny from tax authorities regarding its intercompany transactions involving intangibles such as patents and trademark. Now, implementation, what did they do? They entered into advanced pricing agreement. The company proactively engaged in bilateral advanced pricing agreements with tax authorities in its key jurisdictions, securing agreement on its transfer pricing methodology. They also open regular communication. So the DEF Pharmaceutical Company maintain regular communication with tax authorities to discuss changes in its business operation and ensure continued compliance. You can see that regular engagement is very important. Then proactive monitoring, the company perform regular reviews of its transfer pricing policies to ensure they remain in line with the agreed advanced pricing agreement terms. By obtaining this advanced pricing agreement and maintaining open lines of communication, DEF Pharmaceutical achieved certainty in its transfer pricing arrangement and minimized the risk of audit or adjustment. That is the outcome. So transfer pricing risk management is very, very crucial. We've looked at the definition of transfer pricing risk. We've also looked at the definition of transfer pricing risk management. We've talked about the strategies, to manage it and all that. So just to round up, in conclusion now, effective transfer pricing risk management is essential for businesses to navigate the complex regulatory environment, avoid disputes, and ensure compliance with local and international tax laws. So by maintaining comprehensive documentation, using data-driven solutions, engaging proactively with tax authorities, and ensuring consistency across jurisdictions, companies can mitigate their transfer pricing risk and achieve long-term compliance. Thank you for your attention.